What if I told you that you could pay all of your bills from your stock portfolio instead of your paycheck? Wouldn't that be a dream come true? In this sponsored video, we're going to react to my paycheck doesn't pay my bills, my portfolio does, and see how this guy is living the American dream of not having to go to work anymore in order to pay his bills. He just puts money in investments and survives. Now, you can do this with multi-millions. You can definitely do it. Or you can believe that you're doing that when in fact you're rapidly depleting your portfolio. I suspect this guy is the second, but we'll see.
Everyone, happy June 1st. Wanted to talk about how my paycheck doesn't pay my bills, my portfolio does. If you're new to my channel, I'll use this image from time to time just to make it simple to understand. So my W-2 income rolls in, it goes into my brokerage account. I don't use a traditional banking account. Once it clears the brokerage account, I invest all of my funds into dividend and growth assets. Those dividends will pay a good chunk of my bills, and then whatever is left over, my margin kicks in and pays the gap. And the cycle will continue until my dividends snowball and pay all of my bills, which will...
Okay, I'm already seeing the word margin. So margin is when you borrow money to purchase investments. And the reasoning is that you can amplify gains by borrowing money in order to purchase additional shares. For example, if you have $100,000 and you can borrow $100,000 on that $100,000, well, guess what? Now you have $200,000 of purchasing power. Unfortunately, you're also paying interest on that $100,000. It's a liability. That margin is money that you owe to the brokerage firm. And if your balance drops below a certain equity amount, which is your assets minus your liabilities, you will get margin called, which means you have to deposit more money or sell some of the investments. Margin is very risky, and you also pay interest. And interest rates, I don't know if you noticed, across all assets are much higher recently. So it's going to be a struggle to compensate for the interest expense in order to make money from this. But let's see what this guy's doing. Maybe I'm judging too soon, okay? But so far, it's fine. W-2 income into your brokerage account, yeah. I mean, that's where it comes from. You got to work first. You make the money. You invest it in dividend and growth assets. You could just say the S&P 500 or the total U.S. market or the total world market. It's the same freaking thing. And then he gets into margin, which I'm a little concerned about.
Will then allow me to be financially free. I want to talk about Albert Einstein's quote below there. I've mentioned this on a prior video, but compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. What a lot of us do is we go to work, we exchange our time for money, we get our paychecks, we spend those paychecks to zero, and then we got to go back and do it all over again. Essentially what I'm doing is I'm taking all of my income, I'm investing it, I own an asset, that asset grows and or pays me and or does both. And then it allows me to compound quicker as opposed to just saving or investing what's left over at the end of the day. I want to jump into my portfolio just so you can see how things are going. So I started out here on the balances page just to try to clear up some confusion I see in some of the comments. My net.
Okay, so the total market value of the securities is $233,000. But then he has net account value of $118,000. So his portfolio, if you don't count in the debt, is $233,000. But your actual value is your assets minus your liabilities. It's like a home. You have a house, but you have to subtract the mortgage in order to calculate the equity of your home, your actual net realizable value. This guy looks like he's borrowing about $114,000. Yeah, you can see it right here. So he's got net cash margin balance of negative $114,000. This guy has a $114,000 loan. And if you're paying 10% interest on that, you can quickly do the math. That's a lot of money. So I hope you're getting really good gains, and I hope your interest rate isn't that high.
Net portfolio value as of this morning is 118,514. My gross portfolio value is 233,000. That's the total value of the stocks that I own. So a good analogy for this is thinking about your house or your home if you own one. This would be the total value of the home. This would be how much I own or how much equity I have in the home, just for an analogy there. My margin is right here. So this is the amount of...
God, why would you take... It's just so much debt, dude. Like, I just don't understand why people do this. I mean, like, why are you borrowing that much money? You have to pay interest on 104. That's a lot of interest. Okay? And if we go into a bear market, the value of your portfolio drops precipitously, but you're still paying the interest on that $114,000. And then if you get a margin call, but you can't deposit the additional funds, you're forced to liquidate. So you're forced to sell your securities at the worst possible time, when you could just not use margin, not pay interest, and just continue to dollar cost average into bull bear markets over time. I don't know why people make this so difficult.
The margin I've used, which includes some times I've invested in buying dividends and or floated my bills when I first started. If you scroll down here to the bottom, my paycheck rolled in on Friday. You can see that here. This will clear on Wednesday of next week. And when this amount clears, it'll immediately get dropped into my portfolio balance. And
it's a pretty decent paycheck. That's what's going to bail this guy out, is he's throwing $5,000 at it a month. You know what you could do is just, or whatever his paycheck, I guess bi-monthly, bi-weekly. What you could do is just invest $5,000 a month and not pay interest. Is that too hard? I don't understand.
And I'll be able to invest and buy additional assets that will grow. One way I secure my account is I always keep my equity right around 50%. So what I'll do come Monday is I'll take this 2.18% of my account. I'll go buy more dividend paying assets or growth assets, depending on what the market does, and we'll compound from there. Looking at my complete view here, we'll talk about this. So as of, again, Friday close, my net account value, we just talked about that. My total unrealized gain is sitting right about 28,000 approaching. My day's gains on Friday were 990. The cool thing about this is I'm living out of this account. It's not stagnant. It's not just sitting there. So I'll show my
Okay, I don't recognize a lot of these. I think that's McDonald's, Costco, and then it looks like some yield, like covered call ETFs maybe, that are based off of QQQ, the ETF. It's just a standard portfolio, dude. And the historical returns and probably future returns are going to be 10% or less for all of these assets. And I'm wondering what interest rate you're paying on your debt. I don't think you're actually making any money, because the interest that you're paying is hurting you significantly. Okay.
Transactions, just so you can see. So you can see that I'm living out of the account. You can see right here, this is a payment. We're getting ready to go to Japan next week as a family. So I'm exchanging some US currency for Japanese yen. You can see Apple, Amazon.
Why are you living out of your investment account? I don't understand, dude. Your short-term bills and investments should be totally separate. Totally separate. You should have your checking account where all your bills come in and out. And then if you need to pull investments, transfer it from your brokerage to your checking account. Don't mix the two. Investments are for long term. That's all they're for. Checking bills are for short term. Simple as that. Okay, I don't touch my portfolio. I reinvest the dividends. That's automatic. And I have yet to really sell any shares from the stock market. I just buy them and hold them forever. You should not be in and out, transaction here, transaction here. It's too much. This is a mess. This is a mess. What's going on here?
Clothes shopping. My wife went to PetSmart, Kroger. So this account is not stagnant. It's being used to live out of. It's also being used to invest out of. So when you see my account value, that includes spending. So it's being used as spending. So I get growth, I get compounding, I get dividends. If you go to the estimated income tab.
Yes, you can get all that just by buying one index fund. You know the SPY has a dividend. You know VT has a dividend. Do you know that the total U.S. market has a dividend? It all has dividends, and it can all grow. Okay? You don't need to have this complicated portfolio, and you definitely don't need to borrow money to do it, especially in a higher rate environment.
You can see this will ebb and flow, as I've showed in other videos. But currently, it takes the last payments and it annualizes those on E-Trade. So currently, I'm sitting at $44,406 for the year.
Okay, number one, if you're investing in a lot of high yield investments, you think you're getting a lot of income. I've said this many times. You think you're getting income, but you're actually not. A lot of it is return of capital. You're just getting your investment back. If you give me $20 and then I give you back 10 the next day, I just gave you back $10. That's not income. A lot of these people really think that the $10 that comes back to them the next day is income. It's not. Some of it might be. Maybe I made a profit on some of that $20, but the vast majority of it is just return of capital. And what you're going to think is you're going to think that you can live off $44,000 in dividends, and you can't. His portfolio is, what, 200-something thousand dollars, and he's getting 44,000 of estimated dividends. That portfolio would be depleted in a couple years. Guaranteed. And on top of that, you're paying interest. No freaking way he's getting $44,000 of dividends a year. There's no way.
The next month, you can see I'm sitting at 3,700, actually 3,800 there. So my bills are about 95,000 to 100,000 a year. So as this snowballs and this gets higher and higher, eventually that will allow me to be free from a 9 to 5, essentially. So looking at my performance as an update here, this is cumulative performance. So we'll start at a 3-year. So you can see my 3-year performance. I'm sitting at about 68% there. You can see the S&P is at 42, the Nasdaq's at, we'll call it 58, the Dow's 27.
Oh, look, he beat the market. He must have the secret sauce. He even beat the Nasdaq. Maybe I'm wrong to criticize this guy. But, I always wonder, how are the returns calculated when margin's thrown in? There might be some weird stuff going on, but I guess he has beaten the market. I can't knock him, right? Do you think he got lucky, people? Do you think he actually has a smart strategy? Or do you think he's temporarily doing good? I'll let you decide.
The Russell's at 10. If you go to the 2-year, I'm just showing you each one of these for transparency. 54%, 38%, 44, 25, and 13. 1 year, you can see doing really well here post.
Yeah, and I'd like to factor in the interest expense and see if he's still beating the market.
Tariff situation in April. So on the 1 year, I'm sitting at 43%, S&P 12, Nasdaq 14, Dow 9, and Russell a little bit negative there. And year to date, you can see outperforming the indexes as well. And the reason this is because I'm getting growth from my growth stocks, and I'm getting cash flow. Even when the market's down, I'm still getting cash flow. And that's how this cycle works.
I guess it's that easy. You just get growth and cash flow, and you beat the index forever. While paying massive margin. Okay.
And that's how I live out of the brokerage account. So again, one more time, just to summarize, I'm living out of this account. Money is being spent out of this account, but I'm also getting growth, which is fighting that current. And I'm also getting dividends, which is cash flowing. And I'm also growing and compounding my account.
Yes, until you hit a bear market, and then you don't. Now, I noticed that he started in 2022. I mean, that was kind of the bottom of the bear market, and we've had a lot of high beta stocks rocketing recently. I don't know if that's sustainable forever. And then you add interest expense on top of that. I mean, maybe, like I said, maybe he's got the secret sauce to beating the market. I don't know. I highly doubt it. And if we go through a protracted bear market, which is always possible, you always have to think about the downside, not just the upside. This guy's going to be in a lot of trouble because he's going to be decumulating from his account. He's going to quit his W-2 job. The market's going to be going down. He's going to be pulling a lot of money out of his account to survive and paying interest. And that's a very high-risk scenario.
We have a calculator here on Discord. If you decide to join the membership, which I'll post in the comments, we have a couple calculators here. We have a pro calculator. If you go in here, you can type in your starting portfolio value, your starting margin debt, your W-2 contributions. It takes into account the inflation.
Drip yield 21%. Okay, let's just keep watching.
Rate, living expenses, and then the blended dividend yield. So I start out with these blended dividend yields. So we talk about some closed-end funds.
Oh, I see why he's beating the market. Okay. I see why he's beating the market. So he's got, I guess from the bottom up, I recognize NVDY. So he's put his money into a synthetic covered call ETF on NVIDIA, which has done fantastically recently. The NVIDIA has done fantastic. So that's boosted his portfolio. QQQI, I assume that's an income ETF for QQQ. That's done well. He's got the SPY, and he's got Misty, MicroStrategy. So he's invested in a synthetic levered Bitcoin investment, which has also done well recently. He's got YMAX. That's another high-yield dividend ETF. You can't focus on the recent past performance. What you have to focus on is your future risks. And he is highly concentrated in some highly volatile investments that have done extremely well recently. And that makes you wonder, if we go into a bear market, who are going to be some of the bigger ones to fall? I would hazard a guess. MicroStrategy, NVIDIA, QQQ, YMAX. Well, I don't recognize some of the other ones. But a lot of these would fall, and they'd fall hard at the worst possible moment. So just consider that. I know I'm a Debbie Downer. Sue me.
They pay you a dividend here, a distribution rate. Some of these actually even drip at the NAV, and I want to talk about that just real quick here. So looking at Cornerstone's a closed-end fund. It just went through a rights offering. So every Friday they update their net asset value. And as of Friday, their NAV was at $6.56, and their trading price was at $7.77. So right now we're sitting at about an 18.5% premium there to NAV. And so if you own this stock, every month when they pay you the dividend, they'll drip your dividend down at this NAV price, which is really great and allows you to basically realize immediate gains. So on the Excel file, I have...
How are you realizing immediate gains? They're taking money from the ETF, distributing it, and then you're reinvesting it. So they're sending you money and then you're putting it right back in. How are you getting gains? It's trading at a premium to NAV. Okay, some investments do that, but I don't know how you're getting these free gains. If gains were that easy to get, they'd be arbitraged away. I guarantee you. You don't think hedge funds would latch onto that?
The closed-end funds here, the dividend boost is that drip at NAV, okay? And then you have the blended yield. If you use these specific funds that I have here, your blended yield would be about 47%. In the comments of YouTube, I always say conservatively 25 to 30%. And in reality, it's a little bit higher than that, depending on what blended stocks and assets you buy. I have allocation here just on this spreadsheet. Again, this isn't my whole portfolio. This is just a good starter. We have 50% here. We have 25% here and another 25% in these funds. And so basically what the calculator will do is it will start with your gross portfolio value. It will go to your drip dividends. These are the ones that drip at NAV and will compound your account quickly. The non-drip dividends would go towards your bills and your interest. So again, these would be used as cash here. These would go towards compounding here, just for clarification. Interest paid the first month would be $0. Your cash after interest would be $401. The monthly expenses, including inflation, would be $7,500. So you would start out using basically $7,000 there of a bridge, and we'll take it all the way across. Your W-2 income would come in. This would be the coal into the steam locomotive that keeps the engine running. And then if you go all the way down,
yeah, the locomotive is devouring your money with interest.
Basically, when you see this turn to $0 here, and again, the stock market's not linear, so it's going to go up and down. This spreadsheet looks at it from a linear perspective, but in reality, it's going to fluctuate. But
I guess you can just fire in 60 months. I'm trying to stay calm here. I don't know if I can do it.
Looking at this example, just showing you the power of compounding, on month 54, the non-drip dividends would be enough to cover the monthly expenses in this scenario, to where somebody has a $30,000 portfolio. Their W-2 contributions are $125,000 a year. Again, a 4% inflation rate is calculated into this. And we're saying somebody has an annual living expense of $90,000. Okay. And that's how it would work. So just for clarification, it takes monthly expenses, it adds 4%. It takes your W-2 on this, and it's adding each cumulative month there essentially, but the calculations don't take that cumulative month and add it up. It's calculated correctly for each month in the cells. And you can see the specific cells there. When you double click, you can actually see it up here, how the calculations work. But if you're interested in looking at the tools, feel free to reach out to me, and I'll post all the membership information there in YouTube. All right, guys. Hope you have a great...
God, I'm so concerned, guys. I don't know what to say anymore. I don't think this is a good idea, personally. I don't think you should borrow money. I don't think you should put your money in highly speculative synthetic ETFs that pay you distribution yields that are way above the historical returns of the market. I would just be very cautious. But anyway, that's the reaction. This is a sponsored video. It's $50. If you want me to react to a video or you want me to cover a topic, I don't do stock price predictions or valuations. See the pinned comment below. It's $50 and I'll do a video for you. Hopefully you enjoy the video. Like, subscribe, check out the memberships. You get special members only videos and you get priority comments, and have a wonderful, delicious night.